Good morning, everyone. Welcome to today's webinar, Non-QM 101, Intro to Non-QM for new loan officers and support staff. And for those of you who were registered for the event a couple of weeks ago, my deepest apologies for having to reschedule the event. I am Rose, I'm the host, and I was unexpectedly hospitalized that day, so I had at least a good excuse. So today I'm going to turn it over to today's speakers, Jim and Damon. James, take it away. Oh, before that, if you have any questions, please go ahead and type them into the questions function little tool. What we're going to do at the end is going to have an extensive Q&A, and we will get it to as many of your questions as we possibly can. Thank you very much. Go ahead and take it away.
Thanks, Rose, and thanks for setting this up. Well, welcome everybody. Jim Voizard speaking at you from sunny San Diego, California. Another warm day, but it's not going to last. It's going to be in the 50s this weekend and rain. So welcome to the non-QM seminar for those that may not have done or closed or funded a non-QM loan. Let's go to today's speaker. I'll give you a picture of the two of us. That's James in the upper right corner. My partner Damon's in the lower left corner.
Hello, everyone.
My finger was too fast on the mouse. So a little bit about us. Damon, go ahead.
Yeah, about us. Thank you, Jim. We were founded in 2015. We're nationally headquartered here in sunny San Diego. As Jim said, it's 75 degrees today. We also have centers in Rhode Island, a new one in Georgia, Utah, and Missouri. Another thing that I wanted to tell you about our team is that we are highly experienced on our management side. Our average time in the business is 25 years for every single one of our management employees that we have here. And we lend in 47 states, and we're growing all the time. Next slide, Jim.
I would say that's 25 years of fun, right, David? We've had fun doing this.
It's been nothing but good times. Well, what do we do? What do we do here? I would say that 85% of our pipeline is bank statement lending, bank statement with jumbos. We're going to get more into that a little bit, but I just want to kind of briefly say that that's probably our biggest product. We also have an asset depletion, asset qualifier, where we take people that are cash rich and make them, give them a loan based on what we can qualify their assets for as far as how we break it down on a ratio. We do serve the A paper people. Our average FICO score is above 700. We do loans for foreign nationals. So we have a pretty wide product calendar for you. But what we don't do any Fatty Freddy loans. We don't do FHA or VA. We don't do HARP. We don't bust out foreclosures. We're not hard money. We don't do second mortgages, and we do not do home equity lines of credit. How about our low FICO, Jim? What's the lowest we could go?
FICO scores begin at 600 and above. The 510 FICOs don't work too well at Lensure.
So we're not going to do a 550 FICO regardless of the equity. Is that correct?
99% of the time, no. So let's talk real quick about the definition. What is a non-QM loan? My view, first off, stands for non-qualified mortgage. A non-QM loan is not insured. The lender takes all the risk. We see the non-QM loans that we've been producing since 2015, serving a underserved segment of Americans that just missed and could not quite get a loan from their local banks. A lot of our loans are done to self-employed people. Fast-growing segment in our world is self-employed folks, and we must rely on other documents, alternative documents, to qualify their income. So the tax return goes away, and we look at people for their deposits, cash flow, etc. A non-QM loan has been around since 2014. Last year, the industry funded in excess of $25 billion. This year, the indications are that we'll serve over $50 billion in non-QM loans. Think about that kind of money going into the American economy. We see it as a good thing. So the industry, our partners, as well as Lensure, we think we're the best, but we'd like everybody participating in helping the American economy grow, and these loans do just that. The guidelines associated with the non-QM loan is vastly different than in the world of QM or insured loans. And we're going to talk about how and where we vary and how we can qualify loans that sometimes banks just can't get qualified. The process is different, and for that, I'm going to let Damon take this slide over.
Jim, I got to tell you, the beginning of the slide is how is it different than conforming process? Well, I could tell you it's vastly different. You used that word in the last slide, and I love it because it is vastly different. When you apply for a conforming loan, rather, you have to run your DULP, you have to get your AUS finding, and then from there you just start checking the boxes. But once you're ready to go, you send in the file, it gets checked off by the lenders, underwriter, and away you go. Well, not with non-QM. We really want to see, we don't have an engine like AUS. We look at the file case by case. We make that decision based on the merits of that file. So we have all hands-on human touch. We laid all our box checkers off, Jim. And now we have people that actually look at the file, look at the merits, look at the compensating factor, and we make a decision within 48 hours depending on that loan, on the merits of the loan. Did you know, Jim, that 40% of the loans in our pipeline have at least one major exception?
I knew it was high. I didn't know it was that high. And I know also that some of our loans might have 2 exceptions to the guideline. And we can give you an example of an exception. It could be as simple as a 45 DTI, which actually leaks over to 46 or 47. Doesn't mean it's not a loan. We're going to look at the guy's credit. And in that instance, where the DTI is slightly over, we're going to look hard at the residual income. If that makes sense, we're going to make the loan even though the checker could not check that box. We'll do the loan regardless.
100%, 100%. So with that, where I'm kind of bringing that back in as a segue, is we're exception lenders. A lot of lenders out there, they're going to give you a box. If you don't fit that box, you're out. Where Lensure is going to look at the entire file, and based on the compensating factors, we know if they're going to pay their mortgage. We know if this loan is going to sell to the investor. We already know. We've been in business for a very long time, and like I said, our management has 25 years average for each manager. So we know who's going to pay us. We know it's going to sell. We know what a good loan is, even though it doesn't fit the box.
One thing we do well for a non-QM borrower is we know the borrower has tried to get the lowest rate in town, so they've tried the banks. The loan officers try to get them the best rate for which they may qualify. So when it comes in the door to a shop like ours, we're looking at why is it here? What's the elephant in the file? We address the elephant up front so that we're not dealing with the problem, why the borrower couldn't get a bank loan. We're not going to deal with that 3 weeks down the road, then upset the loan officer, upset the realtor, upset the borrower. We're going to ask a series of questions up front that deals with the elephant in the file. And every loan is a story. And Damon, how many stories have you heard?
A million. A million. Everything. I have this list of LOEs, and anytime I find a really fun one, I put it into a folder. I have this big folder of LOEs. I love it. Okay, why bank statement loans? Well, self-employed borrowers can't go to conforming lenders. They just can't. They're not allowed unless they use their 1040s, which, as everyone knows, a lot of self-employed borrowers in the U.S. get a little aggressive with their 1040s. What we like to do is we like to look at their bank statements and qualify these self-employed borrowers. So they come to us, and the self-employed sector is growing all the time. Right, Jim?
Damon, the self-employed, yeah, exactly. The self-employed borrower is looking to do what most of us do, pay taxes on as least amount of income as possible. And that's just what happens. So in many cases, it's a near miss. So the self-employed individual resorts to other alternative means of income. Could be assets, could be bank statements. I want to say that ATR matters, so the ability to repay is not waived in the non-QM world on owner-occupied loans. We still have to qualify the income. Many opportunities open up using bank statements. It's probably 55% of our book of business is based on 12 months or 24 months bank statements.
Right.
The non-QM process for a bank statement loan is fairly simple. As we said, we're going to find out what the issue in the file is up front and address the elephant. The homeowner, the borrowers up front, you guys work with them. You simply submit 12 or 24 months of bank statements along with a 1003. and a credit report. We're going to ask them to fill out a self-employed questionnaire so we can take a look at their business. We know that a self-employed borrower has two things. One's revenue, how much, how consistent. Two is expenses. So we're looking at what do they make in the business? What's the take-home pay? That's why we need the SEQ to tell us about how many people may work for them. Is there a cost of goods? Is there rent payments? What's the business? What's it cost to run that business every day? All businesses have some level of overhead. So the SEQ answers that question. When the bank statements come in, they're immediately looked at inside by an upfront credit person, who today we use a thing called AI, artificial intelligence, who submits the bank statements into an engine, and all of them, the arithmetic and the math is done for us in what, David, 1 hour, 2 hours? It's amazing.
2 hours.
When we were seven years ago, we were doing these manually. So the turn times on these are it's pretty fast. So the submission process, bank statements, 1003, credit, what's the elephant in the file? Why is the loan here? It could be just as simply as it's the income didn't work at the bank.
Can I highlight on this a little bit, Jim?
Go right ahead, sir.
Well, when I was a loan officer a long time ago, I would always run into bank statement deals, and they would always confuse me because every time I would do my own analysis, I would send it into the bank and they would do their analysis. They would back out certain things that I didn't know needed to be backed out, or I was adding things that didn't need to be added. It was really frustrating for me. And when I started seeing the product here at Lensure, it was one of the most attractive things that make me try and sell this product because the underwriter does this for me. I don't have to have that headache of trying to figure this out. I contact my Lensure account executive. I give them the bank statements. I say, hey, can you please give this to your team and let me know what they're going to use for income? I supply a self-employment questionnaire with those bank statements. Boom, within 2 hours, I get an answer and a legible figure that I could use so that I could send my borrower out there shopping over the weekend. It's a great product, a great product.
One of the unique things about Lensure and why us, if you have a self-employed borrower, let's say you have a married couple, one of the spouse has a business, we require 2 years minimum. They've got a business 5 years in running. And when we do the analysis of the revenue versus expenses, and ultimately the DTI is 51%. That's 1% too high. However, the other spouse happens to have a W-2 job or some other level of earnings. Could be a retirement check, could be a pension plan, could be Social Security. That income would be considered to use to qualify the loan. It doesn't have to stand 100% on just the bank statements. Is that correct, Damon Bailey?
100%. 100%.
A couple things an underwriter would look for in a bank statement program. They're going to look at the consistency of the deposits. If it's erratic and it's not very often, that's going to hurt the odds for approval. They're going to look hard at the expenses. We've got to get to that ratio. So they're going to look hard at consistency, level of dollars, minus the expenses, what's left over. I'll let you guys look at that slide for a second. We don't need to read them all to you. As I said, 2 years is the minimum time we require for someone to be self-employed to qualify for a bank statement loan.
All right, Lensure bank statement programs. Why do you want to use a Lensure bank statement program? Well, we've been talking about this for quite a bit, so I'm gonna fly through some of these bullet points here. So let's just click through the bullet points, Jim. There we go. All right, so we have our 12 and 24-month options, but the next bullet point I want to express is that P&L statements are not required. You have a lot of lenders that want a CPA to verify a P&L, and that could be arduous for the loan officer. What we're going to do is we're going to take that self-employment questionnaire that we fill in with the borrower. So the broker and the borrower fill this out. They send it in to us. And from that self-employment questionnaire, we're going to assign an expense ratio to the file. And I just want to go on that, but I don't want to get too far off the slide. But when we're looking at expense ratios, I just kind of want to go over this with you guys because this is kind of important. If you have someone that owns, say, like a restaurant, I mean, their expenses are quite high. You know, I mean, given you're probably looking at 75 to 85% expense ratio, and it makes sense. You know, they're bringing in a lot of money, but there's a lot of money going out to rent, to cost of goods, for labor, all these kind of things. this expense ratio is going to be vastly different than, say, a realtor or a ballet instructor or a swim instructor. These people are relying on their own education, their own licensure to get things done. What's their expenses? What we're talking about, what, maybe gas, maybe a cell phone, maybe some marketing materials. So their expense ratio is going to be much less. All I want to say is that we look at each business individually. If you have a business that has a low expense ratio, we're not going to give you 50% like other lenders might. We're going to look at it. We're going to make a good determination. If we can prove that their expenses are low, that they're only 20, 25%, then we'll assign it that, and then we'll go forward.
David, what if a borrower has two businesses and two sets of bank statement?
We will accept this. We will accept it. I mean, we're going to verify both businesses. We're going to see where the cash flow goes through, and we're going to have to tell the story a little bit more, but we will accept it. Absolutely, 100%. And on that topic, Jim, the borrower does not have to be 100% owner of the business. Say you have a borrower that has maybe 50% interest in this business, maybe a 25% interest in this other business. We're going to still use both those streams of income.
Thanks, Damon.
You're welcome.
All right, it gets us to the next. You already talked about those. Let's move to the next topic. Come on, mouse.
This is a good one, Jim. You're going to like this.
I can't get it to, I can't make it move.
There we go.
The topic is investors. We know that.
There it is.
Call it the wealth builder. So how many people on the call today happen to work with investors or attend events called investor club meetings? One of the hottest things happening in America today is people buying not one, not two, not three, not four, up to 10 properties, and they're building portfolios. And each property they buy is a cash flow effort to see how much income we can produce out of a given property. That's working on property one, they're looking to buy property two. We're seeing multiple loan requests from investors asking for 4, 5, 8, or 10 loans. Great product. I call it the DSCR, which simply stands for a debt service coverage ratio. We're looking at what's the debt on the mortgage versus what's the rent from the property. And it's one of the hottest things happening today in America. Now you can verify income 4 different ways for an investor. You could do a full doc. You get a slightly lower rate, but a lot more underwriting time and frustration. You could use bank statements as well. The third one over, the DSCR, that's a simple one. We'll let Damon talk about that. Damon, do you need tax returns on a DSCR?
Absolutely not. The DSCR is a great product. We can I would like to refer this as like almost a no doc loan, which is unheard of in this time and age, but we have this product, and the way that we get it through is we're not dealing with the primary residence. So we're looking at this investment property as its own entity. How does this entity generate income? Well, we figure that out with the appraiser. The appraiser is going to tell us what the market rents are for that area through the form 1007 or 215, I believe, for multi-unit. So the appraiser is going to tell us what the market rents are. If those market rents cover, we'll go into this a little bit longer, but if those market rents cover the payment, the full housing payment and taxes and insurance, then that investment property acts as its own entity, its own source of income. And we look at that product like that. So it separates itself from the actual borrower, and we lend on the merits of that investment property.
So somewhat of a streamlined process, right, Damon? You're looking at an appraisal, we're going to verify the down payment, and we're going to look at a credit report. Three elements, really.
Yeah, well, Jim, when you find that investor that has, like you said, 8 to 10 properties, and they start to feel comfortable with the product and they see how easy it is, all we're really doing is supplying an appraisal with the 1007 and information on that property, but we're not looking at anything else. We'll go into this a little bit further, but I have to stress that the investors that we're dealing with multi-property portfolios love us, and they keep coming back, and not only for cash out refis, but for purchases.
Thanks, Damon. A little side note here. On a full doc loan where someone's trying to borrow money on a property that's non-occupied, we look at it a little different than Fannie's rules as far as cash flows. Of course, the investor wants a positive cash flow. But in some cases, when you apply the 75% vacancy factor, et cetera, the cash flow is not there. So if it's negative, Vantage rule is, and this has been relaxed with many banks, Vantage rule is they're going to take any negative cash flow and call that a payment and add it as a debt. At Lensure, we're going to simply take the negative cash flow, if there is any, subtract it from the borrower's income. The effect on the DTI is dramatic. Sometimes you could lose a loan if you're going to add that as a payment. Taking it from the borrower's other income often works in your favor, and the DTI qualifies. That's a one-off with your account executives. If you run into that situation, just give your AE a call. Damon, let's go over the math here.
Okay, so yep, that's the full doc advantage with the Lensure. It's not having that negative rents on there. But again, going back to the DSCR, where we're not looking in that kind of situation, we're looking at the investment property as its own entity with least amount documentation as possible, income documentation. So I want to go back to this ratio that we're talking about. So what we do when we first pre-qual the deal is we start looking around at the market rents, whether that's through your realtor or it's through, some of the websites, Zillow or Redfin or whatever. You get an idea about what the market rents are. When you order the appraisal, the appraiser comes back with the form 1007 or 216, I'm sorry, not 215. And this will show us what the appraiser's opinion is of the market rents in that area, that neighborhood. So that is your key number. And as long as that revenue piece, that market rent covers your principal, interest, taxes, insurance, and any association fees, then you have a loan. Then your income is done. And there is no other, we don't have to verify your 1040s like Jim said or anything else. That's it, we're done as far as the income piece. I do want to mention that if there's a possibility that it goes under 1, if the ratio drops below 1, well, we're going to make that exception. Like we said, we're exception lenders. We'll go all the way down to 0.8 on a purchase. So if for whatever reason we get the process going and it comes in and it dips below 1, that's okay. We're going to still look at the file. We're still going to make an exception on this based on the compensating factors.
Damon, this DSCR product exploded in a big way onto the scene about 3 or 4 years ago. And there's a lot of loans out there. If you're not participating in working with investors, you're missing a rather large boat. That's all we can say about that. There's a lot of opportunity here.
It's half my pipeline right now, Jim.
That's 50%, Damon, right? Is that right?
That's 100.
Ease of
Correct.
use. Damon mentioned all of these. We'll let you guys read them.
Yeah.
So on that's a misprint on the mortgage. We do look at mortgage ratings. That will matter.
Yeah, that's a mistype. If we do have a 1 times 30 on your primary residence, that could hurt the deal. But we aren't verifying your tax and insurance. We're not going to beleaguer you with all the different tax and insurance documentation for all the other properties. Can you imagine if your investor had 20 different properties and we have to list that on the REO with all the taxes and insurance verified? It'd be a nightmare. So we don't even look at that. That's a big scratch.
That would take 2 weeks. That last bullet point, David, on the fast closing, what's the turn time on these?
I mean, if we have a full package, Jim, it's considering there's no rescission time, we can move very quickly to CD. I would say we could get to CD within 10 days if we have a full package, maybe even less.
Normally find that these run about as fast as your appraiser can run and get the appraisal in the door.
Yeah.
We're normally waiting on the appraisal.
There's no documentation. I mean, literally, it's a quick loan.
Great product. Hope you guys start using it if you're not already using it. Here's a switch. Not a program. This is more of a term situation. So this terms 30-year, 5/1 ARMs, 7/1 ARM. We're talking about terms of a loan. Lensure features what we call a 1040, fixed rate interest only. So 10-year period of paying the interest only. The larger the loan, the bigger the savings. You guys know that. It rolls into a automatic predetermined interest rate to a 30-year loan for a total 40-year term. So the 10IO rolls to a 30-year fixed. Becomes a 40-year loan. Great product, for those folks that are getting into the larger loan sizes. We see many of these, this loan is used often on loans from 800,000, a million, 1.5 million plus. The payment savings is tremendous. Great product for your borrowers to get payments to where they can see, oh, wow, it's affordable. I want to do this. It works on a DSCR. This term, this 1040, works on all of our loans, whether it's DSCR, full doc, or a bank statement loan. Doesn't matter. It's a great product. I'm not sure many people offer this, but if you're not using it, talk to your AE. It's a great way to compete in the marketplace. What it does, the 1040 drives the lowest payment in the industry. When you use it, we'll talk about it later. When you use this product in conjunction with our rate cutter buy down feature, Dave will talk about buying the rate down. When you combine buying the rate down with the 10IO, payments become very low, very competitive. It's a very hot tool. As we all know, there's no prepays on owner ocs. Non-owners, there is a 3-year prepay period. As we mentioned, this 1040 is eligible for all doc types. Anything you want to add to that 1040, Damon?
Well, I know that it just is selling like hotcakes on the jumbo market right now. All the brokers that I'm dealing with that have high net worth individuals with high loan amount transactions are taking advantage of this 1040. And as far as I don't know, Fannie Freddie doesn't have this, especially when you're talking about something that's outside of their conforming loan limit, even their high balance. Now you're talking about a borrower who's out there looking for a jumbo loan. He's looking at the portfolio lenders or credit unions or brokers or whatever they could find. Well, I guarantee you that once they start to lock in on this 10-year interest only with the 40-year fixed term, the 10-year that converts to a 30, they jump on it. They see the savings, they know they're fixed, they know they're secure, and they go for it. It's one of our top products with jumbo lenders right now.
Thanks, Damon. Next hot market, this keeps building for us, foreign national loans. Yes, we write loans to foreign nationals, and we see more of these every day. The segment itself is growing. Folks, the people are coming here. You can look at the numbers to see where we're at, where we're going. What we find in foreign nationals is larger loan size, massive, large down payments, excellent credit histories from wherever they may originate and live. Couple key things to a foreign national. We're going to ask up front what visa they may hold. I'm not going to read to you what a foreign national is. You can read that for yourself. But when we get these applications, we're going to ask what visa do they hold. And we're going to look at the 1003 up front to see what address you're indicating on the 1003. For a foreign national, it should indicate their address in whatever country they live in. One of the great things about a foreign national loan at Lensure is the income qualification piece. It's not that difficult. They hold a visa, they want to buy a second home here, they want to buy an investor. The income piece is relatively easy. In many cases, it can be as simple as a CPA letter, which talks about their income and their income average for the last 2 years. We don't use foreign tax returns. We don't use foreign bank statements. It's as simple as a CPA letter. Credit, 3 trade lines, 2 of those got to be open. That's all we're asking for. Up to 75% for a purchase. Like all of our programs, a foreign national there's no mortgage insurance. As we said, the lender takes all the risk on these non-QM loans. David, what's your average loan size been running on a foreign national?
I'd say anywhere to 500 to 750. And just to kind of elaborate on that, the perfect foreign national borrower, this is kind of an example, is where you have a doctor from, say, China, and they have foreign income, they have foreign assets, but they're always in the US for whatever reason, and they want to buy, say, a condo in Miami Beach. Well, that's our borrower. So we're going to get a CPA to verify the income and the assets, and boom, we're done. We're off and running. So, I mean, we will look for some type of foreign credit. You know, if they don't have a credit score, if their country doesn't have a credit reporting system, we'll write some letters to some of the creditors in the foreign markets that they're in, and that works for us. They have to be translated, but after that's done, we're done.
I've seen a trend in the last, we'll call it the last 4 months. Very wealthy Mexican buyers looking to buy second homes in the United States. And many of them, believe it or not, are in the Colorado, Utah area. They're buying ski locations. And those loans, as you know, the loan size on those type of properties, ski in, ski out condo, these are $1 million loans up to $2 million loans. So you want to add a lot of volume to your business fast. Find the foreign nationals in your marketplace and tell them you got a program for them that works. Another hot one today is the non-warrantable condo and our Condotel product. As we all know, many banks have a problem with doing the non-warrantable condo loans. We look at them. There was some recent guideline changes, right, Damon, to this business. They're asking for an HOA questionnaire that's now been lengthened to more than 3 pages long. And we won't go into the details of why that happened, but I think most people can figure out what happened last fall that drove this change. So many opportunities, because there's a lot of real estate in this country called a high rise, a mid rise, a condo, that's non-warrantable and for a variety of reasons. We can talk about some of those reasons on one of these upcoming slides. The questionnaire is required. Ours isn't quite as lengthy as Fannie's or Freddie's, but we do require a questionnaire. There's some of the reasons they can't get the loan done. Here's some of the reasons that we can get the loan done. We'll consider every type of condo, including ones with litigation, although we got to preface that. If you got construction litigation issues, that's going to be a tough call.
Certain litigation, but we have this file right now where the litigation refers to not our unit, doesn't involve the HOA or the developer. It's not structural. It doesn't involve our unit specifically. We're going to make that loan. Whereas Fannie and Freddie, they're going to trip all over that all day long.
The non-warrantable that talks about the occupancy rate is 50% or greater, and it's non-owners. That's a fallout. We see a lot of those. A single entity owns more than 10% of the units in the building. We see that one quite often. Project not 100% complete. That's talking about phase 4 of 6 phases, and the first 3 are done, but the next 3 are not complete. We'll look at those that are completed. Unit owners not in control of the HOA, that's an underwriter call. We look at those. It's not an automatic no, but the underwriter, and we all know underwriters, they're going to ask questions about what's happening here. Don't we love our underwriters? Where would we be without our underwriters, Damon?
Be me and you, Jim.
We see a lot of these in Nevada, Las Vegas. We see a lot of these in Florida. We see these in California. There seems like there's a non-warrantable project somewhere in every state in the country, right, Damon?
That's right. Especially Hawaii and South Florida.
So income-wise, we could do these loans in a variety of different ways. Bank statements, full doc. Sometimes they're going to be rentals, so you're going to go DSCR. Got a great 1-year and 2-year 1099 option. Yes, those are 4506T verified with the IRS. We see these with asset depletion. Damon mentioned the qualifier loan for people that have some money in the bank. They don't want to take it out. Their funds are otherwise employed, earning them 5, 6, 8% returns. Why move that money? They'll come to Lensure, get a loan based on their assets. Leave the money alone. David, how many non-warrantable condos would you see out of your last 20 originations?
A good percentage. For whatever reason, we had a complex where one entity was starting to buy up, and they were at about 15% of the units. So that one was non-warrantable. We still did it. We had a mixed use. We had a high rise. We had one that had it was in phase 3. We had one where the builder was still in control of the HOA because of the new development. So a lot of new builds were falling under that non-warrantable condo. We funded all of them. The brokers were more than happy to push forward, especially with the EMD and a closing on the line. They were ready to make the move, and they were very happy we had the product.
David, what is this bullet point that talks about merged income, full doc and asset depletion?
Oh, that's a great one. That's a great one. So if someone is cash rich but does have some small strings of income, we can blend both those two sources. So you might have someone that's towards the end of their career, and they still have a decent income coming in, but it's just not enough to make that DTI work. We're going to also look at their assets, and if they're cash rich and if they have enough in the bank, we're going to use that as a determination for their income. So it definitely helps when you're tight.
Damon, are you saying if the asset depletion would get the borrower to a 48 DTI, but the program has a max of 45, you could use other income and add it on top of the asset depletion?
Well, yeah, let me give you a better example. We just did one for a retired gentleman. He was 70 years old. He had, like 1.3 in the bank. And after we did all the income and the breakdown on the asset qualifier, he was at 51% DTI. And so we're like, I don't think we have a deal here. Well, I asked the broker, I'm like, let me see, do you get SSI? Oh yeah, we get SSI. We get the Social Security each month. Well, that paycheck came in at $3,800. We grossed that up to 125%. Now my DTI is in line. We close the deal.
Nice. That's a good example.
Yeah, it was awesome.
Damon, are you seeing a lot of fallout for condo deals because of the new Fannie guidelines, and how do we handle those?
100%. So, I mean, the first thing we're going to do is pre-qual the deal right away to make sure that it is non-warrantable, that it does meet those guidelines, that we're verifying why Fannie kicked it out, and we're going to pick it up and do that loan. But to answer your question, yes, especially with all the new second homes that are coming in, people want to buy a Condotel, people want to buy a high rise in downtown New York. These kind of deals are coming across our desk all the time now.
Awesome.
Another buzzword that's gotten hot in the last 24 or 36 months, Condotel. 10 years ago, that term didn't exist. It does today. A lot of folks don't like making loans on them. I'll let you read what they are. We see Condotel inquiries every week. We have a requirement on a Condotel. Sometimes these are formerly hotel rooms. One of the requirements, one of the rules is a minimum square footage. I want to say it's 600.
Yes.
However, being a lender that looks at exceptions, we're not box checkers as we said up front. We had one approved last week, $400,000 deal in Maui. The square footage of the unit was 392 square feet. Because of its location, where it was, demand for the property, turn times, market time, strong borrower, high FICO, square footage rule was waived. Did we price the loan a little higher for the risk? Did we add a quarter to the rate? Well, we probably did, but we made the client happy because couldn't get the loan anywhere else. Lensure solved the problem. So we see that quite often. Again, common sense exceptions are made. Call us. A few guidelines. You want to mention any of those, David? You can.
The only one that I really want to highlight, you already said the square footage, and that how we have made that exception before, but it has to have a kitchen. That's one that has been a point of contention with some of the files that I've seen. We have to have a full stove.
With an oven. We had that last week. We had a property that had a stovetop. Had a stovetop but no oven. That became a problem.
Yep.
So they went out and installed. Yes, they went and installed an oven.
Yeah, that's a fact.
Again, that's 75 LTV. If you got a strong enough borrower with a lot of compensating factors, you might get that to 80. You always got to call your AE. Oh, there's a kitchen right there, Dave. It's on the bottom. Full stove.
Yep, gotta have it.
I'm trying to think, who wants it? You're on vacation in Hawaii. You're wanting to go to the beach. Who's baking pies in the oven? That's just a funny rule.
Well, I mean, what about the guy up in Aspen, that has the ski in right there, and he gets snowed in? So I kind of see that.
Okay, I got you. Let's bake a pie while we're here. Okay, Damon, great. One of the best things about Lensure that's very unique in the industry is our rate cutter. Talk about our rate buy down program.
This is what makes Lensure an extra special player in the market. So I'll give you an example. You have a purchase. It's at 85% LTV. The borrower has reserves. They have enough down. They're coming to the table. They're looking at the settlement statement, and they see that they have to pay the broker 2 points that they have to bring to the table. That's a bitter pill for the borrower to swallow. They're thinking about what couches they could buy, how they could furnish their new home, all the great stuff that's happening, but they see their cash coming out of their account and going to the broker, well, or the lender. Well, where Lensure kind of comes in is we've negotiated with our investors something that's very unique. So we're able to take that 85% loan and we're able to finance the broker's points. So the broker wants 2 points up front, fine. That new LTV is now 87%. Your borrower isn't bringing that money to the table. We're financing those points for them. And what is that those points do for the broker? Well, it gets them paid and us at par. But if we have to buy down the rate, we'll actually finance a point to us. So we'll finance a point to the broker, a point to us, or even 2 points to us and really get that rate down to our very, very bar minimum, which is changing as everyone knows. But it still gives the opportunity for the broker not only to collect their own points by adding to the LTV, but also by buying down the rate by financing lender points, discount points. This is something nobody else does. Does that sound kind of like what you'd be interested in, Jim?
Yeah, let me clarify a few things, Damon. So on a rate buy down, are you saying the interest rate instead of 5.5 is 4.5, and the LTV, which would go up because we're financing it, we're not going to raise the rate back into the next LTV bucket?
Correct. It stays in that 85. In our example, it stays in that 85% LTV bucket.
So
we're not
the borrower
taking
gets a lower rate, the borrower gets a lower payment.
Absolutely.
And his rate's not going up because his wow, that's a win-win.
It is a win-win, especially when we blend broker points and lender points or discount points to be financed. So it's if your broker is just looking for a real fast close and they want to get it done and they're only charging a point and they love the borrower and they love the realtor and everything's good, great, we'll finance the broker point. If they want that lower rate, if they want to keep their rates below where the market is, great, give Lensure a point, we'll buy that rate down for you. But we'll finance both of them so they don't have to bring that to the table.
Great product, we call it the rate cutter. And if you're not using it, call your AE, let them walk you through it. It will enhance your business. Well, David, we're towards the end of this little presentation. Why partner with Lensure? I'm not going to read that, but I'll say off the top and let David finish it. Why partner with Lensure? One is, I'm going to go right back to that rate cut. That's unique. Two is our unique 10-40 interest-only program, which rolls to a 30-year fix. Three is that first bullet point under why partner. We talked up front about exceptions on loans and our human touch ability to look at exceptions to the guidelines to see if it makes sense to still make the loan. I think we do that better than anyone in America, and it's one of the best reasons to get to know if you're not working with us. It's a great reason to get to know us. David, I'll let you take the rest.
Jim, did you know that 40% of the loans in our pipeline have an exception?
I think you said that twice. I think I got it down. It's good to know.
No, I just want to highlight the point. We're exception lenders. We make exceptions. You're going to find yourself with other lenders and you get down to the 11th hour and they're going to fumble the ball and you're going to lose the relationship. You're going to lose the borrower. It's going to be a nightmare. We do two things to make sure that doesn't happen. We do write exceptions, but we'll also, like Jim said, we'll give you that pre-qual decision. We'll give you a credit decision up front within 24 to 48 hours. You're already knowing that this deal is going to close. And you know that if you do run into a spot and you have enough compensating factors, we'll probably make that exception for you.
And how easy is it to get a loan started with Lensure? Easy. Use your email, send your AE a 1003, the IRLA. We all love the new IRLA. Send them a recent credit report. And for using income docs, send that. It's that simple. Call your AE. Within 48 hours, you'll have that loan priced. The issue in the file, sometimes called the elephant, will be worked out. It's that easy to submit a loan to Lensure. we'll even work the loan up for you before you're approved as a broker. We'll get you a rate, get you a pre-approval.
Yeah, I love the fact that we could get a credit decision up front, that when you're in underwriting, you already know that we're good to go.
Our phone lines are open as well. Once you submit a loan, you can talk to an inside person that's working your file other than you can always talk to your AE, but you can also talk to the loan processors inside the building and our credit analysts who are working your files. We don't let you run everything through the AE. You can call us. We will talk to you about your file. Thanks, folks. I'm done with that presentation. David, anything?
No, I'm really excited for where non-QM is headed in 2022. It's an emerging market, as everybody knows. Out in the broker world, what I see day to day in person, I'm seeing LOs converting their business to non-QM because they see the value in it and they see it as a huge emerging market. And I just want to express to the audience out there how important it is to be ahead of the game and to know this stuff before the rest of your competition on the retail side sees it.
Awesome. And for the attendees of today's live webinar, a special treat that I've prepared for you is our private label resource kit. So if you want to start marketing non-warrantable condos or bank statement programs or foreign national loans, this kit provides you with email templates, with flyer templates where all you have to do is click on it, insert your logo, put in your contact info, and you can start sharing this information with real estate professionals and with your borrower base and start generating new business today. So with that, I want to make sure to go ahead and enter in your questions on the Q&A tab, and we will answer them for you. I'm getting a lot of questions about the yes, you will get a recording of this webinar. I know we went through a ton of information today. Yes, I will send you a copy of the slide deck so that you have that to refer to. In about an hour after the webinar ends, look for an email from me, Rose Waldy, that will have links to the private label resource kit, to the webinar recording, and to a copy of today's slide deck. So, with that, so guys, with a DSCR program, do we need to submit bank statements as well?
Can I take that, Jim?
Sure.
If we're sourcing the deposit, then yes, we want to see the assets. For if it's a down payment, then yes, we all want to see about 2 months of the sourced asset. But as far as qualification, absolutely not. We're only using market rents as qualifying for income.
Okay.
Anything to add, Jim, on that one?
No, good.
That's a good question. Okay.
Michael wants to know for that, how many appraisals do we look at and who orders the appraisal? What's that like for non-QM?
I'll take that one. So in most cases, it's one appraisal. Only we require 2 if your loan size exceeds 1.5 million. The appraisal ordering process is started by the broker, logs on to the Lensure website, goes to our appraisal platform page. There's about 12 AMCs that are approved. You select any of those that you like, and you place the order with the appraisal AMC company. It's done by the broker or the loan officer.
Awesome. For our bank statement programs, how low can we go on the expense factor? Jared wants to know.
I think Jim and I would have maybe similar, maybe different answers to that. Jim, you want to elaborate, and I could tell you what my thoughts are on it?
Well, personal bank statements. Personal, you're giving us 24 months of personal, could be as low as 10%.
Yeah, that's what I would say.
Business bank statements are going to be based on what's the expense in the business. As David said up front, a self-employed realtor, self-employed insurance agent working out of their home doesn't have a high expense factor. They have some expenses. That could be as low as 10 or 20%. On the other side of that spectrum is a restaurant owner or someone that's got a small manufacturing facility. That could be 90% expense factor. David, you can add to that if you like.
Yeah, I mean, we really do look at the merits or how the business runs. On the restaurant thing, I used to work in restaurants, and fine dining restaurants had extremely small margins, but they brought in a lot of money, and uh, their per person cost was quite high. But on that, I just did a loan for it was an Asian pho restaurant. They make pho, that Vietnamese soup. Well, the cost of goods on that soup, and we proved it. We showed what the we showed what the cost, how much they're paying each month. The cost of goods on that dish was like $1, but they were selling it for like $15. So in that situation, we gave that restaurant a 65% expense ratio. So we can flex with if we can prove it, if we could show the expenses in the right way, if we could tell the right story, you could get that restaurant expense ratio down. Or, all I'm trying to say is that we're flexible. We have a varied way of determining exactly how much is coming in through the business.
All right. So, Sunday wants to know, as an LO, less is more. So given the choice between a 12 and 24, 4 months bank statement, they're going to go 12. Is there a price difference between the 12 and the 24?
0.125. It's an eighth higher for 12 months.
Okay. And also from Sunday, there are self-employed borrowers that don't have a business license. Is a business license required for the bank statement program?
No, it's at
Underwriter
the
call.
underwriter's discretion.
Good answer, David.
Can any of these loan programs be used for commercial properties?
Short answer is no.
Okay.
We're a wholesale residential platform lender.
There's a couple of questions from about DSCR. Can you qualify DSCR on interest only option?
Yes.
And is there also an option for interest only for 5 and 10-year IO?
We don't do a 5-year IO. We have a 10-year IO on a 40-year fixed. That's our IO option, but absolutely it qualifies for the DSCR. I try and push my borrowers actually into that IO product because the property will cash flow so much better and because it's such a wonderful product. And you could get the ratio above 1. So if we have a situation where we're like at 89 or 92, I always tell the loan officer, well, let's just put it on an IO. We'll be above 1 in no time. And,
Okay.
It works for everyone.
So Michael K is asking, is about 75 LTV, or can we go higher? Michael, I'm not sure which program you're referring to, so go ahead and put it in the comment again. But
Probably
let's talk.
Condotel.
Yeah, let's talk a little bit about the LTVs and how high we can go on particular programs.
Well,
Jim,
our max LTV is 90% on an owner occupied property. Requires a little higher score. DSCR purchase loan, if you're trying to buy a rental, you can get as high as 85%. And as we mentioned on a foreign national purchase, 75%. So it depends on the program, but as high as 90. Cash out loans is a little bit less than those numbers. But remember, 90, 85, 75, depending on the program.
Okay. Michael did respond. Yeah, he's talking about investment programs. How high LTV can we go on investment programs?
85.
Awesome. And Aaron wants to know, for DSCR, how are potential Airbnb investments looked at? Will appraiser comment on that or look at properties as a regular rental and not as an Airbnb?
Two things there. Go ahead, David, you want to go first?
No, that's a really good question. We run up against that all the time. And as also with the ADU, how are ADUs allowed to gather rents? The appraiser really has to be involved in this situation. When there is an ADU that could be used as like an Airbnb, that ADU has to have a kitchen, by the way, for the appraiser to give it rents. So if it's a legitimate permitted ADU and you're using Airbnb rents, we would hope that the appraiser would find similar properties with ADUs that have completed kitchens and that have those kind of rents also.
Cynthia wants.
Hold on, Rose. On that, that's a good question. Airbnb income is up, as we know. It's a big business in America today, huge. The owner of the property that could show 3 months of Airbnb
Yes.
activity of deposits coming from his Airbnb rentals will help the file if the appraiser's not giving you everything you need. So that's not an automatic no. If they're actually collecting these rents and we can see it in their bank statements as in the form of deposits, we're going to lean forward.
So Cynthia wants to know, it has to have an oven? No kitchenette allowed?
For Condotels, yes. Going back to the ADU thing, it is kind of state specific now that I think about it. I think California, it's not required to have a stove and an oven, but the one I did, like I was in Aspen, actually, we weren't allowed to give that ADU credit because it didn't have a kitchen or an oven. So I want to say for ADU anyways, it's state specific. For Condotel, always.
Okay. And Judy, I see your note. Judy's got a deal that she wants to talk to somebody about. I'm going to have somebody call you. I'm going to have Damon and Jim call you as soon as the webinar is done. I have your phone number. Don't worry about it. We'll take care of you. What's the minimum loan amount for foreign nationals?
200.
David, 200,000. But
200.
we never see them that low. There's usually 5, 1 million, $1.5 million, $2 million.
Yeah,
Can you
200 loan amount. 200 loan amount.
Can you
Correct.
close in 21 days on a clean package?
100%, especially if we have the appraisal up front. I got to tell you guys, that's been the bottleneck. Is a lot of our brokers, they're waiting for the conditional approval to order the appraisal, or they'll order the appraisal maybe after the LE has been disclosed. These appraisals have to be ordered right away. There's been a huge bottleneck, especially outside of California. We have some North Carolina properties where I'm looking at 3 weeks right now. So you guys order your appraisals up front and quick.
Okay.
Yeah,
Zachary,
that process. Go ahead, Rose.
Zachary wants to know, do you review self-employed borrowers with mixed personal and business returns?
Jim, you want to answer that?
That's more difficult. So a personal tax return, I'm sorry, is he talking about full doc or is he talking about bank statements?
Zachary, if you could clarify that that question in the comments, we'll have them address it.
If it's a bank statement loan and it's personal bank account versus a business, we're going to rely on the business, put the most weight on the business. Often the transfers are going to preclude us from using the deposit. You can't count the same, as we all know, you can't count the same deposit twice. So we'll use multiple business bank statements, but using a personal and business, rather difficult.
Okay, so Eric he's got a question. I have a question. I called a realtor today and they have written off most of their income. He made about 200,000 in income on his tax returns are super low. So instead of giving 2 years bank statement, he would just show 12 to 24 months bank statements. He averaged 7 to 10 million in sales in the past 2 years.
That's something we want to look at.
Yes. 2 year, 24 months bank statements and no tax returns.
Can you talk a little bit more about non-warrantable condos with litigation? Kitty wants to know.
That's kind of that's a broad topic. What is litigation? What are the variants in the different lawsuits that are part of a complex? I have one deal going right now. The complex has 1,500 units. And there's a list of litigation that goes long as your arm does. It's incredible. So what we're doing is we're asking the HOA to get their legal department to write us a letter and tell us that our subject property, our unit, is not pertaining to any of these lawsuits, that none of these lawsuits are structural in nature, that they're not suing the developer for the building of the property or the structure of the property. As long as we could kind of figure those things out, then we're going to move forward even if there is litigation. If we know that it's minor in nature, it doesn't pertain to our unit, it's not structural, we're good to go. But we have to ask those questions.
one note would be the lawsuit itself, the 4 or 5, whatever it is, 25-page legal document, will be reviewed by the underwriter. So always think about your friendly underwriter and that kind of stuff he's going to read, or she. Just think about that.
Kim wants to know, what's the lowest credit score on a DSCR for 15% down?
I got a rate sheet right here. I think you're correct. You're such a smart guy.
Let's see. I think we talked about the the Airbnb question as income. On an investment property, what if the property needs work, electricity?
That's a great question. I just lost a loan because we had subject to repairs. That appraisal has to be as is. We don't do, I know Fannie and Freddie allow for like a $500 deferred maintenance. We don't. That appraisal has to be nice and tight, has to be as is, has to be ready to go. If we have to get out, if we have to send the appraiser out for a 442, we're going to require it. So if your property is not complete, we're going to back away from that one.
Can we do foreign national Airbnb loans?
Well,
the answer is yes. It'd be based on the track record. So they already own a property here. If they're purchasing one, there's no track record. If they own one and it's been Airbnb rented, we're just going to look at the history.
Okay. And sorry guys, I think that is it for the general questions that I have. A lot of the ones that I have are specific to loan scenarios. And for those of you guys, I'm going to reach out to you afterwards because I want you to get as complete and accurate information as possible. So I want to make sure. And yes, I'm getting a lot of comments about those marketing materials that I promised. Don't worry, look at the email that I'm going to send you in about an hour, and there's going to be a link on there to the private label resources. So you will be able to go to a Google Drive and download anything you need.
Rose, can you include my phone number? I know that you're going to give them my email address, but could you give them my phone number as well?
Sure.
Guys out there, I work 24/7 just like you guys do. I mean, loans never sleep. I'll answer my phone on a Sunday at 5 o'clock. I mean, just call me. We'll talk it out. All our AEs here at Lensure are extremely knowledgeable, and we don't turn the phone off at 6 p.m. We're
Hey,
all
David,
the time. Yes.
David, I'm closed on Sundays, but I work late nights.
All right. Well,
thanks, guys. Remember, Lensure Mortgage, Lensure. Be sure to remember us when you have a deal that doesn't fit Fannie Mae. Call Damon, call me, call your local AE in whatever state you may be located in. Thanks for your time.
Jim, wait, one more thing. Did you know that 40% of our pipeline has exceptions on them?
I'm glad you brought that up. Thanks, guys. Thanks.
Well, with that, I would like to thank everyone for attending today's webinar. Have a good one, everyone. Thank you. Okay.